At some point in every audit, you're done. You have sufficient appropriate audit evidence. You're ready to issue your opinion. You have completed all your finishing audit procedures. You have considered all the secondary issues. And now the time has come to issue our report. In an ideal world, we will issue an unmodified report using the standard wording that is found in the auditing standards. I included a sample audit report on Canvas, but you could also find that in the AUCs if you need another copy. In order to issue a standard audit report, some things have to be true. The client has to provide all 4 basic statements. We had to satisfy the professional work requirements. That could be independence, competence, all those matters. We have to have had sufficient appropriate audit evidence. The client has to have followed all the relevant financial standards. So this is not generally accepted auditing standards. This would be GAAP or IFRS for an international company. There has to be no scenario that requires an explanatory paragraph. And don't worry, we'll come to that in a moment. If all those are true, then we can issue a standard audit report. Now, if it's not true, we're going to have to modify our wording. Modified wording does not necessarily mean that there's a problem. It might be that there's something we need to draw the reader's attention to. And so the most common one is actually an explanatory paragraph. And this is where we need to add some details to make the context of the audit. A lot of these are not about necessarily informing the reader, but defining our legal liability. So for example, if we're going to rely on the work of others, then we're going to have to include an explanatory paragraph, or we will be assuming full responsibility. So we could reference them in every paragraph saying, we didn't do this work, or we make no reference, and that means we're accepting responsibility. So how do we decide whether we're going to reference the work of another? And by other, it's not referring to management, it's referring specifically to another audit firm. So for example, a lot of European companies have mandatory audit firm rotation. So for a company that consolidates its financial statements, the European operations will be done by one auditor and the US one will be done by another. If they were both done by, for example, a Big Four firm, US office versus European office, it would look very unexpected if the US office was to qualify, they're not confident in the European division's work. And so, but if it was PwC and a KPMG client and you're issuing for both, then you would probably want to reference it to deny responsibility. But some factors you can consider before you can rely upon the work of another auditor is, what is their reputation? If they've got a good reputation, you're more likely to be willing to rely on their work. If you can't rely on their work because they have a bad reputation, then you'll have to replicate that work yourself. The other auditor isn't independent, you can't rely on their work. If there were significant issues, you'd ideally like to review their work, or at least as much as necessary. If if there's problems with these, you might actually have to issue a scope limitation or go back and gather additional evidence so you have comfort on these issues. Next issue you'll deal with is a going concern. And we've talked about this in the past, but a going concern is a situation where you're not confident the client can survive, or there's reason to doubt the client can survive one fiscal year. And so if we do have that concern, we can still issue an unqualified opinion, but we're going to have to add an explanatory paragraph. So it's not that we're saying the financial statements are materially misstated, but the client has properly disclosed it. Then we can simply add an explanatory paragraph highlighting it for the reader that you need to be aware of this critical issue. Disclaiming an opinion is where we simply, it's not that we say there's a problem, we say we have no opinion. We're walking away from the client. It's equivalent to a resignation. There's not a lot of value in an audit opinion that disclaims an opinion, but it's technically one of the options. And so a departure from GAAP that is justified could be permitted. And so we're not talking about an immaterial departure. We're talking about a scenario where the client has departed from GAAP, but it is somehow justified. And so in that scenario, we need to make sure the reader is aware that the normal rules do not apply. And so now the scenario where it's a GAAP departure that is not material or pervasive. So we want to include the paragraph in the third paragraph if this information is not available. The reader should state the fact. Emphasis of matter might be is a scenario where we simply want to draw the reader's attention to something. And so It could be a significant related party transaction. It could be subsequent events, and we're going to talk about those later on. Comparability issues, material uncertainties. So you're going to see all these different issues that don't make the financial statements misstated. They just put a context in which the reader needs to know information to understand the financial statements. Lack of consistency is a critical audit issue. Sometimes consistency is allowed, sometimes inconsistency is not allowed. So if there's a change in accounting principles, i.e. the client voluntarily changed accounting principles, or there was a regulatory change, you need to notify the reader that the underlying principles that prepare the financial statements have changed. If there's a change in reporting entity, i.e. merger, some restructuring, you're going to need to let the reader know that through an explanatory paragraph. Or if you've moved from an unacceptable to an acceptable accounting principle, you need to let the reader know what's going on. Now, you wouldn't need to let the reader know. There would be no special disclosure or special emphasis if there's a change in accounting estimates. For example, if the allowance for doubtful debts changes year to year, that's not an issue that requires special attention. If there's some errors that are corrected that aren't really accounting related, you don't need to do it. The client changes the format. For example, in the past they were reporting 5 prior years. This year they're only going to report 3 prior years. That would not be something you would need to do that, because that's not a requirement that you disclose that. So a little acronym or mnemonic for you to help memorize. Non-standard reports are serious, and so this gives you this. These would all be ones that are free of material misstatements, but there's something the reader needs to know to understand them. Now, it gets more complicated if we have reservations. And so a reservation is not necessarily a disaster. What it means is we've got concerns. And so the first type is a scope qualification. That means we have insufficient evidence. And so a lot of this depends on why we have insufficient evidence. And so sometimes it's circumstance imposed. So for example, a hurricane hits a fiscal year end, destroys a warehouse, and we can't verify what the year-ending inventory was. The client's not trying to hide the evidence from us. An executive passes away. There's turnover in leadership and we can't verify things. These are not choices by the client. And so in which case we'd be more likely to qualify, i.e. issue an opinion, but put qualifications and limitations on our opinion. Now, if the client's the one not providing us evidence, they claim proprietary information, they do not make executives available. This is much more serious because it's a choice. The client won't provide us the management letter. If these are the scenarios that are happening, we're more likely to issue a disclaimer of opinion, or again, deny an opinion, because we don't know what's going on. It doesn't require that we do, but we'll evaluate whether there's greater meaning there. The final possibility is a departure from GAAP. And so a departure from GAAP is a major issue. This is where the client has voluntarily chosen to depart from GAAP, and we need to decide, is it sufficient to issue either a qualified opinion, meaning everything is accurate except for, or an adverse opinion. And so an adverse opinion is where we say the financial statements are materially misstated. And so what would determine that is both the materiality and the pervasiveness there. So a single large error can be enough to issue an adverse opinion. But several smaller areas, material misstatements that cross over several different accounts can be more concerning. And so we want to pay attention to those. There are a few, I call them zebra scenarios, very unusual scenarios that you won't normally see. A lack of independence. During the audit, you lose your independence. And so that could be a scenario, an audit partner gets hired by the client. And so in that case, the audit firm can no longer engage in an audit with an audit, and they need to resign from the engagement. Now, if that happens, the auditor must state any material misstatements they found. So they can't provide positive assurance. They can't say, we are confident what we found, there were no material misstatements. They can't say that. What they can say is, we are no longer going to be able to audit the client. However, these are the material misstatements we found. And comparative financial statements create problems, especially if there's different opinions. And so we'll need to look at those when those scenarios arise. And normally you would go to the standards for specific guidance. A summary chart for you, in case this was a little overwhelming. The way this normally gets realized in the real world is you do all the evidence and you're going to go to the standards, you're going to meet with the audit committee, and you're going to have discussions. It's not normally going to be a confrontational approach. What happens in CPA testing is you're given a scenario and asked which audit opinion you give, which is why a summary chart is really great to have memorized or to have reference easily available, because you basically just need to find out what scenario is true. The nice thing is, since materiality, somewhat material, very material, are all matters of judgment, you're not normally going to be asked to make those judgments. It's going to say that this was a material and pervasive problem. And then you're basically being fed this scenario and you just need to identify it rather than using your judgment. So we're going to have lots of follow-up questions, I'm sure, but this was an introduction to audit reports.